So what is venture capital and how does it work? Well, essentially venture capital is high risk investment in a project, and typically that project is a new business. Typically venture capital funds are only really suitable for those raising over £2 million or more. It's kind of after the seed funding stages, the angels, the family offices, the high net worth individuals that might be investing at a very early stage, known as angels. You then have venture capital is the next step. So typically speaking, you're in a position where you have a product to market, that product is generating revenue. Usually you are in a position where you have you're approaching 80k per month in monthly recurring revenue, or you have like $1 million in annual recurring revenue or annual run rate. So you're in that sort of you're an established startup, but you've still got a long way to go. And that's the point at which most VCs like to get interested. Most venture capital funds like to get interested in a business. Now, these VC funds have a particular way of operating, and they are very much unicorn hunters. They're looking for those big deals that could blow up big, become $1 billion company, deliver them 100x return or more. They're looking for everyone they invest in to have that kind of rock star potential. Unlike angels, who would be happy with maybe a 10-20x return, a business that's worth maybe $50 to $500 million, but not necessarily looking for a unicorn that's going to be $1 billion business. That's perhaps too high risk for them, and they look for a lower type of return. They're happy with that lower type return. And if it does end up being a unicorn, then happy days. But the VC is very focused on finding that potential unicorn, investing in lots of businesses, taking strategic bets on those they think they have the best chance of becoming a unicorn. So they're very much unicorn hunters. Now, where do they get their money from? Now, unlike angels or family offices, angels are investing their own personal wealth. Family offices are investing the personal wealth of an ultra high net worth individual on their behalf and managing their money. VC funds are a business. They essentially operate as a business, and they're an investment house. They have people who invest in their funds on the promise of a return. So it's almost those with capital outsourcing the due diligence, really. A lot of people refer to VCs as a due diligence facility. I've got money I want to invest. I don't want to have to seek potential investments. I don't want to have to do the due diligence on them. I don't want to have to think about the investment strategy. So I'm going to partner with a venture capital fund. So they raise a fund of a certain amount, and that could be anything from 100 million to 500 million or more. But they raise a fund of a certain amount, and they raise this from LPs or limited partners. And these LPs could be a range of people. It could be ultra high net worth individuals. It could be pension funds. It could be trust funds. It could be insurance companies. It could be a family office has invested into the venture capital fund rather than directly into the startup themselves, depending on how they like to operate. But they're usually talking institutional investors investing into VC fund, who's then going to manage that investment and make sure that the right strategy is implied so that they can get the returns. Now, these returns that they're looking for are typically a 3x return. So if I was to invest in a VC fund tomorrow, I would be expecting to get a 3x return for my money when the fund closes. When you exit all of the businesses in the fund, I should be aiming for a 3x return on my money. That's the typical expectation. And the fund is usually managed in a 40-40-10 split. So for any given fund, let's say it's a £100 million fund to keep the numbers easy, 10% of that, 10 million, would go in operating costs, managing the fund, making sure that they have a bit of reserve, making sure they can pay all their investment analysts, making sure that they can provide support to their portfolio of companies that they invest in. 40% will be set aside for follow-on investment. So they know they're going to take on a certain number of investments into their portfolio, and they're probably going to need more investment in the future. So we're going to resserve some money for future rounds of investment so we can protect dilution, so that we can invest in the stars in our portfolio and really help push them forward. So we're going to set aside 40% of the fund for follow-on investments, and then the final 40% is going to be the money we invest today, the first investment we make in a business to bring them into our fund. So that's typically the way that they split the fund. And with that 40%, so in our case, £40 million in our £100 million fund is our initial amount of investment that we need to deploy for that fund. They would typically have a target investment size. So they'd then split that down further and say, how many businesses do we want to invest into with that 40 million? Do we want to invest £2 million check sizes into 20 companies? Or is our strategy to do slightly smaller check sizes, £1 million checks into 40 companies? Or is it going to be just a handful of businesses with £5 million investments? Now, typically they'll be looking at a portfolio of at least 20. So it would be safe to assume that in our example, they'll be looking for £2 million checks into 20 companies, if not £1 million checks into 40 companies. And this sets the strategy, because this sets the kind of level of venture capital investments that they would be looking for, whether they're in the ability to lead on a round, whether they are looking to sort of follow on some smaller rounds, starts to set the strategy for that VC. Regardless of how they decide to do it, they've got their check size. They know that they are going to be writing $1 million checks or $2 million checks into X number of companies for their fund. We know the target ownership we want to take in order to get the return we're looking for. We know what sort of deal we are doing. So typically the target ownership would be around 15% of the company, or less than that if they're not doing kind of the majority of the round. But the round size would be the valuation of the company they're investing into would allow for around about 15, maybe 20% of equity to be sold. So that kind of sets the valuation of the companies that they can invest into. So if you come along with a valuation much higher than what matches their thesis, what matches their methodology, then they're not going to be interested. They're not going to negotiate with you because it's too high. They need to bring you down to what makes sense for them. They've crunched the numbers. We need to make 20 investments of £2 million at a 15% equity stake. They're the rules of the game. We are looking for founders who are willing to play to those rules. If you're not the right fit for our portfolio. That's how they think. That's how they deploy their capital. This basically means that they're looking for really high risk, but really high reward. That's what they're aiming for. So they know that they need just one unicorn out of those 20 or 40 businesses that they've invested into, or one company that will deliver 100x return or more. The rest will break even, give a small return or fail. The return from that one company that will deliver 100x return or more will pay back all of the losses in the businesses that didn't work out in their portfolio, and that one company will deliver the 3x return that their limited partners are looking for, so they can go back to their limited partners and say, look, we've delivered the return. So they're looking for a unicorn business, one shining star in a portfolio of 20 or 40 businesses, to come out on top and deliver 100x return and deliver them the 3x return they're looking for in their fund. They're not interested in the success rates of startups. Means the strategy of doing lots of mediocre investments doesn't work because the failure rate is still so high. So they're much better off as a strategy looking for that one big win, that big unicorn opportunity, and then that pays back all of the money lost and still delivers the 3x return that the fund is looking for. So as I say, these VC funds play high risks, high stakes game, but it's massively high reward. That's how they think, that's how they operate. And so therefore these VC funds are most suited to very high scale businesses with huge potential, huge market potential for their business. Those that are raising around 2 million or more, and those doing so at a sensible valuation that allows the VCs, the investors in that round, to take 15 to 20% ownership. If you're not within those tolerances, if you want to raise outside of those guidelines, you're most likely going to struggle with the typical VC, with the typical fund, because it's just not how they think, it's not how they operate, and you're trying to force them outside of their playbook, and they don't want to be forced outside of their playbook. There's plenty of people who are within those frameworks, within the rules of the game, as far as they're concerned, that they don't need to worry about you and they don't need to invest in you because there's others that will give them what they want and fit with their strategy. So that's how you should be thinking. That's how a venture capital fund works. That's how they think. And that's why you need to make sure that you really understand the mind of these VC firms so that you can make sure you play their game, you play to their rules to give yourself the best opportunity of raising the investment that you need. Cheers. Bye.